Good morning, ladies and gentlemen. So that was the good morning. That is an invitation for you to take your seat now. Good. I think we still have a few colleagues stuck in traffic. Welcome to Brussels, everybody. But the room will fill up, I'm sure, over the day. It's a great pleasure to see many of you, actually, some very familiar faces, and also a few faces I don't know. So by means of introduction, my name is Olivier Boutelis. I'm the CEO of Accountancy Europe. And it's a great pleasure to welcome you here today, especially as I'm not sure you know what you've signed up to, which is quite interesting. You guys are coming to an event, you don't even know what we're going to do. And what we're going to do today, I think, is talk about innovation. Not the kind of innovation, that has become a religion and that brings now, I don't know, I think I checked this morning, 3 cameras on the back of my phone. I'm always anxious to know the day where I will find 4 or 5. And you know what? It's not going to make a difference to my life. Well, actually it does make a difference to my life, because what it does is that it contributes to exhausting our resources, it contributes to draining our energy sources, and it contributes to adding waste to this poor planet that has enough right now. So it does change my life. And this is not the innovation we're going to be talking about. The innovation we're going to be talking about today is changing our behaviors. It's changing the way we look at the things we've always done so that we collectively become better and build a really sustainable and resilient global economy. That's what we have to do. Our generation, well, I don't know if I can say that because we've got multiple generations in the room, actually. But our generation has a very small time span to fundamentally change what we've been doing in the past 200 years. 50 years is what scientists call the Great Acceleration. It's been going worse and worse, and we basically have 5 to 7 years to fundamentally put it upside down. That's quite a challenge. So we thought at Accountancy Europe that we need to talk about these things, and we need to reflect on the context in which we operate and how we're going to transform our behavior, looking at, that's the program of today, looking at how we report on companies' performance, looking at how we can build a resilient and thriving audit market, looking at the entire business, I would say, and the entire reporting chain so that it all contributes to building this global economy that we need. Why do we do that? Well, because at Accountancy Europe, and many of you have heard me say that before, we represent the entire accountancy profession. What does that mean? Well, that means that amongst yourselves, there are, of course, people working in audit firms, big, medium, and small, but there are also, in our membership, many people working in the public sector, for instance, in ministries of finance or in courts of audit, as well as people working in business. So we're covering, I would say, the entire chain. And we believe that professional accountants today have a key contribution to make to changing fundamentally the way this economy operates, because it doesn't work. So to start, on this journey of today, we think it is important to start by setting the context so that we understand the challenges that we face, so that we understand the mega trends that are currently taking place in the world in which we live. And we thought that to do that, we would invite Professor Peter Hinson, who's with us today. I mean, he has been working on startups, he's been with the MIT, and he is now teaching at the London School of Economics. And he is writing exactly on these issues. So I'm sure we're very impatient to welcome him on stage. Get rid of me by the meantime. And listen to what he has to tell us about the mega trends and the challenges that we all collectively face. Peter, please.
Take the microphone. You might need that. Yeah. Good morning. Pleasure to be with you this morning.
Small correction, it's London Business School, not LSE, but we're slight competitors. Thank you very much for the invitation. And I love events that people show up to if you have no idea what you're going to get. That's quite brave, especially from people with maybe your background. And I mean that in the kindest way. I have probably led quite a different life from most of you, but extremely happy to be here and spend the next 45 minutes with you. So the theme I want to talk about is what I call the never normal, which is a world of constant change and volatility, and what does that mean for companies? And really interested to see what it means for you in this room. This is the very simple professional career slide that I have. This is my entire career in just one slide. It's the transition from analog to digital. I was trying to guess your age because you said, age bracket. Huh? I was trying to guess your age when you were coming in. And I was really wondering if there were still people here who actually learned how to type on an old mechanical typewriter. So, wow, this is a little bit of a geriatric society meeting here today, huh? But I learned how to type on an old mechanical typewriter. And young generation has no idea what that is.
Thank you so much. Such a thought-provoking presentation. Really appreciate it. Thank you. I mean, my colleagues will be surprised, but I even took notes. So you can imagine how good I thought it was. Also wanted to thank you for your point on budget. I'm actually in the middle of my annual ritual, and my treasurer is in the room somewhere and a couple of board members. I hope they did hear the point. It is a ritual. I can't agree more with you. So thank you really very, very much for you. Now, maybe a bit of a more serious comment. What I really loved about your presentation is not only that it was thought-provoking, it's also that you've got a magic of connecting the dots, but also, I think, balancing the dots and showing both the bright side and the dark side, the pros and the cons. And I think that was really, really inspiring. Thank you very, very much for that. I also love the unavoidable Rumsfeld catalog of things. But I think there's something that's missing in that catalog. And by the way, when the President of the United States was getting the 9/11 news, I don't think anything was going through here, okay, knowing who he was. But if you look at the at the Rumsfeld litany, I would say, I think there's an element missing in there. And it's not only the knowns unknowns and the unknowns knowns, it is the we don't want to know. And I think you talked a lot about this, actually, and thank you, because we need to know what we don't want to know. We need to realize it. And even when we talk about, these information companies, the bits company consuming information, there are a couple of things we don't want to know. They also consume a lot of metal. They also consume a lot of rare earth that are very dirty to extract, by the way. They also make us totally dependent, not only with these TikTok algorithm, they also make us dependent from other countries. They consume a lot of energy and a lot of space. And that is the don't want to know kind of category. And I think these are all things that we need to notice as well. And thank you really, really very much for opening Pandora's box a bit. Let's see what we're going to do with it. But before that, next time we won't invite you, I'm sorry. We'll use Copilot. It's going to be a lot cheaper and easier, so that's great. And the bad news is that we have real coffee, the type that you're going to burn your tongue with, you're going to split on your white shirt, and, normal coffee, nothing virtual. So can I invite you to join coffee? And again, please give a big hand to Peter. Well done.
I wanted to put in a couple of touch points that maybe could resonate.
One, two, three. Seems to be working. Next time, we're really going to serve virtual coffee because it's much easier to get people back in the room, actually. So please come back in front of your screen, turn your camera on, back in the room. Zoom is starting. Come on. All right. Good. Well, I hope you enjoy your real coffee. And nobody had some coffee on their white shirt, as I predicted. Predictions are always very difficult, especially on the future, as you all know. I see people start coming slowly. Good. Well, we're going to now have our first panel, and we're going to be looking at what we accountants do a lot, i.e. looking backwards, not even forward, right? But we're going to discuss why it matters, actually. So to do that, we have a fantastic panel, and I'm going to let the moderator introduce his panel. David, would you please join me? David Herbinet, who is with us, the chair of our audit and assurance group, and also partner with Mazar in charge of
audit.
That's a surprise, right? Okay. So, David, please invite your panel, and you'll tell me whether you're looking left or right, but not only backwards, I hope. Okay?
Thank you very much, Olivier. And quite a hard act to come after Peter. Had the pleasure of seeing Peter in another occasion. It seems that his presentation has gone even faster than the previous one I'd seen. I did remember previously is what he calls soy sheet of yesterday that had made a mark clearly in my mind in terms of day-to-day activities. But so much to take on from his presentation. I wouldn't know where to start. I think my brain is in CPU overload at this stage. So let's move to this panel. I'm delighted to host the first panel of the day and have a great panel to join me. So I'll start with inviting the panel. So Isabelle, Gwen, Michael, Tom, if you would like to join me, please. And thank you for being here. So we're going to talk about corporate reporting and why it matters. And I think we can make an easy connection with what Peter told us earlier. He told us about the importance of collecting the dots and connecting the dots. And I think corporate reporting is quite critical to that. The theme of today is the ecosystem and how we can improve the corporate ecosystem. And of course, reliable and quality information is at the heart of all this. So we're going to talk about this for just over an hour. I'll quickly introduce my panel for today. I will let them introduce themselves in a little bit more detail later on. And then we'll try and structure the discussion on three themes, looking again at the ecosystems. So we look at the preparers, we look at the users, we look at the standard setters and the supervisors. So quite a broad range of views to explore this topic. But we'll start with so let me take you through the panel quickly, and then we'll start with the first question. So take it in the order in front of me. So Gwen, you are the global chair of the Institute of Management Accountants. Delighted to have you here. Michael, you are, I'm just checking my notes just to make sure I don't make any mistakes. You're board member, financial reporting board member on EFRAG. Thank you for joining us. Isabelle, good to see you in another context today. You are the head of unit corporate finance and reporting at ESMA. And last but not least, Tom, at the back end, you are content and communication manager with WikiRate International. So let's go straight into our sort of the first question of the day, and I'll ask each of you the same question and give you a bit of time to expand on it. The first question is, why does corporate reporting matter? and where do you see gaps, potential gaps in its quality? So you'll have about 5 minutes each. We're not so much in a rush. And I think we are going to do this in the following order. We'll start with Gwen, and then we'll do Michael, Tom, and we'll finish with Isabelle. So Gwen, why does corporate reporting matter?
Yes, thanks. Oh, yeah, it's working. Now, thanks for inviting us for this to discuss this enormous, important topic. I'm very passionate about corporate reporting. I've been involved in preparing corporate reports, I think, throughout my career. And also, I'm the chair. I was the chair last year of the Institute of Management Accountants. So in that sense, I also wear a hat of educating people to prepare meaningful corporate reports. Yeah, and why does it matter? I think we really want to create transparency via corporate reports to make sure that in the end, hopefully, we create a better world and to give insight in what companies are doing, to give investors an idea about what it is that they're investing in and to hopefully then make conscious choices. So in that sense, corporate reporting is very important. I also believe that what gets measured gets done. So having a good set of key risk indicators, key performance indicators, and tracking that creates hopefully a lot of long-term value for society and for organizations. So in that sense, it matters too. And lastly, I always have a firm hope that good corporate reports can really lead to more balanced decision-making. And to give a quick example, I'm very hopeful also about the new integrated reports, where organizations do not only report on financial metrics, but also on non-financial metrics, and share, I think, more their overall footprint and their ambitions with their stakeholders. And to give an example, if you now read the report of Heineken, the Dutch brewing company, they also really address what are we doing around responsible drinking. And that's really new, and I think that excites me because it's really also about the wider effects of what they do. And again, there's a lot of value in that. I think also, as readers of these reports, that you know better what they're trying to achieve. I'm also a bit critical about certain aspects around corporate reporting. I do believe that it will be more and more difficult to consume the amount of information that we're preparing. I think it was wonderful, our opening speaker this morning, who addressed, of course, we need to go from data to information to content, but the average report now is not 100 plus pages, but 300 plus pages. And I think also the younger generations, they just don't have the patience to go through it. So you're probably preparing the report for AI. And what will this mean? So consuming the information will be challenging. Also, can we really act upon the information? Can we really steer? And the integrity of information will be crucial too. I am concerned about that, the validation. Now we're going to talk about that today. But can we really assess that the quality is there, that it's comparable information? And also what you see, the new integrated reports, there are still few ESG reports that really engage in a meaningful way with the real moral trade-offs. I think that's also going to be a challenge now that we want to see wider implications. What does it really tell us? And there is a burden attached to all the work. It's also good fun. I mean, I love doing it. But the rules are sometimes unclear, and I also wear a hat of a preparer of information. And as a CFO, I will say that the complexity sometimes to understand the new rules and to adhere to it, while you also do not let it distract you too much, because in the end, I think it's really about the organizational narratives and the impact that you want to create. But of course, there are also a lot of obligations and rules, and we're here with a couple of regulators, so I'm very excited to share some insights about that. But it can be a burden. Because the last thing that I want to say, I'm the CFO of a social impact investor, and when I joined that organization 18 months ago, and we also have to report according to the CSRD standards, I was excited, said, I already have that information, because I've been preparing social impact reports for years. But now I have to time the information, make sure that everything is reported with the same time frames. I have to invest a lot. I have scarce resources. I want to use my dollars and my euros for developing countries. So it's really a challenge to also deal with the burden and the uncertainty. For example, if you look at climate change, we also want to do now more with carbon credits. But from an accounting point of view, what is that? Is that a commodity? Is it an intangible asset? So what do you do as a CFO with valuation, amortization? So there are so many unknowns. It's like we're flying in the sky, but we're building the plane. And that's an enormous challenge also. But also good fun, but and important. Yeah.
Thanks so much, Gwen. Michael.
Yeah, thank you very much. That works, yeah, great. My name is Michael. I'm, as said, member of the Financial Reporting Board of EFRAG. Also have a day job, which is at Mercedes-Benz. There I'm a methods accountant, so for the fundamental accounting questions, and also engage with the Business Europe Sounding Board on the accounting topics. I would start off with saying that we're not only looking backwards, because the numbers of today is the business plan of tomorrow. So everything we do is the foundation of the planning, of looking into the future. And of course, also in financial accounting, we sometimes do use prognosis on the future when it comes to impairment testing. But I'm jumping a bit the gun. Why does corporate reporting matter? As a preparer, I must say that corporate reporting, especially financial reporting, and as I'm a specialist for IFRS, that is my, I will focus on that, is the one mean of communicating to capital markets, being existing investors, potential investors. That is the one reliable source of information that gives validity to all surrounding communications, being earnings calls, talk releases, press releases, and so on. So that is a fundamental aspect also of working capital markets. So without corporate reporting, especially financial reporting, I'm pretty sure that the capitalism itself would not work as it works today. And when we already focus on IFRS, on the IFRS framework, then we're seeing, of course, a framework that is designed to provide useful information, so making investment decision, which is per se a financial magnitude, maybe not solely, but mainly. And that is itself is a target for which we measure quality again. So when we ask for the quality of financial reporting, we have to first ask, what should corporate reporting do? Sorry, that's mine. Can we just ignore that? Thank you. I apologize. Oh, I didn't want to answer it. So, where was I? Financial reporting and providing useful information to investors is, of course, the key. It also comes with a very principle-based framework. And that is also the challenge. On the one hand, we don't have strict rules in financial reporting. We sometimes do, but mostly we don't. So we have to focus on the objective. What should financial reporting deliver, primarily to investors? And now that focus is shifting, of course. And these standards have to bring just what the user needs for its decisions. And then user needs, of course, are changing. And sometimes you get the impression that the standards do not keep up with the change in investor needs. And for companies, that poses a challenge, because for us, I say that as a preparer, this is the product that we send as accountants to the capital markets. This is how we present the company. We want to tell capital markets and the outside world, what is that company that you're looking at? What is the financials? What is the prospects? What are our strengths? Maybe what are our weaknesses? And that must be tellable, is that a word? We must be able to tell that to capital markets in the framework regime. And we can observe that objective-based approach is really paying off, for example, when looking at segment reporting, because that really delivers on the management approach, on the way the company is steered. We're also having our constraints, and there's a discussion on power purchase agreements where the standard is too strict and would, well, in the opinion of some, or even many now, would not allow for an adequate depiction of the economic substance of these transactions. And so the key for quality of corporate reporting, I would say, is it must stay, or the framework must stay fit for purpose. And that means, of course, it must evolve. And that brings the challenge, because standard setting also has something to do with providing reliable information. So you can't just tell companies, do whatever you want, whatever you deem useful. So you need a bit of rules, of course. It needs to be auditable. So there needs to be an audit track. I think everybody here understands that. And of course, companies also don't have unlimited resources, just as you said it. We have scarce resources. Skilled people are hard to find, especially at the moment, but in general. And transformation and new information to be provided, it takes time. And another example that just comes to my mind is the supplier finance arrangements, where companies actually are required to renegotiate contracts to come up with the information required by the markets. So that takes time. So we're in a bit of a constraint here. The standard on the one side gives us the guiding rails, which we may not leave, which may lead us to situations where we cannot depict transactions according to the economic phenomena. And on the other hand, it doesn't change quickly enough, so we can keep track on. And then there's investor needs, which are sometimes very well articulated. We're just looking at the activists or active investors asking for more sustainability, climate-related impact. Where is it in your financial statements? As a car company, why don't we impair, for example, intangible assets or capitalized development costs on combustion engine technology? Why is there no impairment? Since we've said ourselves we're going to transform to a fully electric future. And so there is questions, but there's boundaries set by the framework. And so to come to an end, where do we see gaps in quality? I think the overall quality of what we have already achieved is very high. We have a very good corporate reporting framework and landscape, but it needs to stay that way. And in order to stay that way, it needs to develop. And we need to find a way where we can listen to investors, where we can have the safe harbor of a good standard that tells us you're allowed to disclose that this is not a fault, this is not an error, the enforcer is not going to come after you. And so we will develop. And that would be the key for quality. And with that, I would end.
Very good. Thank you, Michael. So Tom, as a consumer of corporate reporting, tell us what you think.
Oh, okay. So my name's Thomas Howie, and I'm the Content and Communications Manager at WikiRate, and I do have some slides. And I'm so delighted to be here today, to be part of the conversation. And WikiRate's work is about increasing the amount of open environmental, social, and governance data available for everyone to understand and shape company impacts on people and the planet. I'm going to start by saying something a little bit controversial. ESG is the devil. Not my words, but the words of Elon Musk. Yeah? Now, I don't quite agree with that, but I would say that the devil is in the ESG detail. And that's exactly what WikiRate platform is about. It's about asking and answering detailed questions on companies. And that's basically, let's take a look at Tesla, or let's take a look at Tesla. We can ask, how much water did Tesla use at its plant in Brandenburg last year? But we can also ask more social questions, like, does it have a childcare policy? And these are real questions that people from our community have asked and tried to answer on our platform. And since 2013, we've collected over 4 million open ESG data points, which are accessible, comparable, and free for all. Next, can I have the next slide, please? But what can you actually do with 4 million data points? Well, actually, it turns out you can do quite a lot. You see, the unique thing about Wikirate is we have diverse data sources. So we don't just collect data from companies, we also collect it from NGOs and also from workers. And so the thing is, we can actually check the promises or the policies of companies with the reality on the ground. And that's precisely what a tool like the Fashion Checker does. Anyone can go on there and see if apparel companies are paying a living wage to workers in its supply chains. And we know that 9 out of 10 companies are not paying a living wage to those workers. But we can also check legislative compliance. So, for example, the Beyond Compliance data dashboard checks if companies are meeting the minimum requirements under UK and Australian law. And we know, for example, when we look at the UK statements, only 2 out of 10 statements are meeting the minimum standards. And the minimum standards are already a really low bar. So those minimum standards are actually only 3 things. The director has to sign the report, the board of directors have to sign the report, and it has to be placed on a prominent place on the website. That's even before you get to the content. They can comply almost with saying nothing in the report. Of course, numbers tell us how companies are doing, but what about the human face of these situations? Can I have the next slide, please? I'd just like to share a story from Nazarene Sheikh. She's a modern slavery survivor, and advocate and speaker. And she says, "I was sent as a 9-year-old to a big city to work and live in a small sweatshop with 5 other children. The room we lived and worked in was approximately 10 by 10, had no bathroom, beds, or running water. We were forced to work up to 15 hours a day to meet our boss's orders. When we didn't get paid. I remember splashing water on my face to stay awake. We had piles and piles of clothes, but only tiny fingers with which to sew them. At night, we would sleep on those piles of clothes. I hated those clothes. They were made through my suffering." Now, I think this says 2 things. One is, when we talk about sustainability, we often think about the environmental factor, but of course, sustainability includes humans. So any definition that we have of sustainability must mean do no harm on the human scale. And the second critical point is actually to prevent the next generation or another situation like Nazarene. We need more and better complete quality data coming from companies for financial investors to be able to redirect financial flows to more sustainable activities, but also for civil society organizations to hold companies to account where necessary. Now, I think that's exactly where accountants can play a really important role. And I was really delighted when I was preparing for this event. Accountants, I'm not that familiar with, I will admit, but I found a fantastic quote, which I think sums up the role that accountants can play. And it's by Jane Gleason White. And she says, "Accountants might be the one last hope for life on Earth, because they have the potential to hold nations and corporations accountable for their impact on nature. In effect, accountants have the power to reconceive nature and society, not as an externality, but as an internality, as an acknowledged component of economies and business." Now, when I heard the words hope and power, just like we had in the previous presentation, there's some cultural references. I had to think of one person. If I could have the next slide, please. That's, of course, Luke Skywalker. Luke Skywalker in A New Hope, the Star Wars epic. And I think that accountants can be like the Luke Skywalkers. I noticed in the previous presentation we had Darth Vader, So at least we've got now Luke Skywalker to balance it out. But we need accountants to get that quality data, because without quality data, there is no sustainability. And I'm really looking forward to having that discussion with you all here today. Thank you.
Thanks so much, Tom. Definitely left and right here. Thank you. Isabelle.
Yes, thank you very much. Thank you very much for the invitation to come and talk today. I think it's a super important topic. So I'm Isabelle Goergenes. I'm the head of the Corporate Finance and Reporting Unit at ESMA, which is the European supervisor. And I actually have been an auditor. I've been an IFRS trainer. I've been a financial due diligence advisor. And I've also been in standard setting. So now I have another hat, which is interesting. So I still have a couple that I haven't ticked. So that of the user, although I do have investments in funds and things like that. So to some extent, and I haven't been a preparer, but I have been in close contact with preparers. So. And it's interesting to see to see all these viewpoints. So why does corporate reporting matter? So some of the previous speakers have touched upon some of the aspects that I want to mention. But first of all, corporate reporting for me is part of a contract. It's a contract between a company and its investors. I as an investor, I will provide you some money to support you. What do you do in exchange for me? So yes, I expect some returns, but I need to know why I'm doing this. I need to know what are the results. So that is your transparency and accountability duty to me. There's a symmetry of information, especially when you go to capital markets. The investor in the stock exchange, he won't have access to all the information that the company has access to. So you need to provide that information in a digestible form. You need to tell them what matters to them. So that's why it's important. What really drew me to accounting was not the debits and credits. It was the story that we tell with it, the role that it plays in society, the language that we define it with. So accounting is a language, sustainability reporting is going to be a language. That's, how do we measure? How do we tell it? That's what interests me. I think, and that's where it's important. And it's interesting to see, from a standard setting point, what are the concepts that we put behind. I remember when the ISB was discussing the conceptual framework, I was working at the French Accounting Standard Setter at the time. We had heated debates about who are the recipients of accounting? What are we doing this for? Is it for the investors? Is it for a broader stakeholder group? And the French inevitably lie in the latter camp. And even embedded in corporate accounting in France, or corporate world in France, there's this notion of profit sharing with employees. So you can see why, because part of the profit will go to employees through specific mandated legal schemes, why the French would say, well, actually, it addresses a broader public than just the investor. If you think of the large companies in the beginning of the industrial world and the role they played in society, in building whole basins of workers coming together, and that was, their salary, their life depended on it. So the company goes bust, and salaries, so the employees have nowhere to go. So I thought it was interesting because in the financial reporting, well, we landed where we landed. And I thought it was interesting that now with ESG, we're coming back to this notion of the broader stakeholder group. So thinking ahead, what impact will that have on financial reporting, 10 years from now? The other thing is, as a securities regulator, our mission is to enhance investor protection, ensure investment protection, and foster efficient markets and financial stability. So investor protection. We, when we supervise, we're kind of in the same position as a user, as an investor. We have what's given to the public. That's what we look at. So that's the frame that we have. And so if we don't understand what's in there, and usually our supervisors are former accountants and auditors, or quite versed in this, if they don't think that they have the information they need, well, they think that the user doesn't. So that's one thing. Also, in terms of efficient markets and financial stability, I think corporate reporting has ripple effects. We need to keep in mind, and it's become extremely clear in the debate in the ESG sphere and how the ESRS interact with the SFRD, that there's an investment chain. So it's not always that, there's direct investors, there's funds investing. And funds have, multiple companies that they invest in. And so what are the numbers that they derive from that? What's the information that they derive from that? So same thing in ESG. So there's ripple effects across the investment chain. And then there's the unfortunate sometimes sort of effect of, a big corporate failure, and then there's another one in the same sector, and then another one, and for the same reasons, and all of this. So there's so there are huge impacts, and that's what we try to prevent as securities regulators, and that's why corporate reporting matters and is what frames our work.
Thank you very much, Isabelle, and thank you all. I think that's, set the scene, provides a lot of context and very different views, which is really good about the topic. So let's move into, we'll have a series of three key topics, looking at it from the point of view of preparers. We'll talk a little bit about auditors and supervision. So if we start with preparers, and I'll start with you, Michael, just to give you a heads up. But if you can share some views, and then we'll hopefully go into a bit more of a discussion. So anyone who wants to come in, feel free. First question is, how can preparers improve the quality of corporate reporting, considering the wide range of stakeholders that we've just discussed, and perhaps looking both at form and substance?
Good question. I would say it starts with the mindset. You can either, as a preparer, look at corporate reporting as something that you have to do, but you don't really care about. You just do what's necessary, and then you publish it, and then you hope nobody asks questions. And I think that phenomenon is not so uncommon as we may want to think. But on the other hand, if you think of corporate reporting really also as a marketing measure, as a means of communication, as a means to show how attractive, how good you are, then I think you have the right mindset to improve quality. You have to have, of course, an investor-centric mindset as it comes for financial reporting. But what Isabelle just said, the stakeholder groups may change in the near future. And that's what struggles us as financial accountants a bit, that we're likely to see in the very near future a, sibling report, a sustainability report, which has a much wider audience. And how do we connect the dots? Unfortunately, I wasn't here this morning to hear that presentation, but of course, connecting the dots, connectivity between financial and sustainability reporting, that will be the next big thing also for us financial accountants, because we have one job, is to tell the story of the company to the public. And that public we define at the moment as the financial community that we talk to. What can we do as preparers? We can stretch. We can stop looking at financial reporting just as a checklist. We can and that's a bit the tricky part, we can of course engage to some extent with the users of financial reporting as what is it that you want from us? And then in the second step, we have to probably step back a little and say, yes, that's what you want, but that's not what the accounting framework allows us to give to you. One example, as mentioned already, is the climate-related effects on the financial statements. If you don't have any, then it's hard to argue that you just tell that in your financial statements because you're actually not allowed to display immaterial information. So we're looking at the user expectations. That is key. We are looking also at the constraints that we have from the framework. And then there's this also a quality topic from financial reporting, from the preparing side. You can't well, change the way you report in a very short frequency because that takes time. It has to be, the data has to be gathered, it has to be compromised, consolidated, it has to be checked, it has to be audited, it has to be presentable, and so on. So that takes a bit of time, and quality comes also with a certain time of steadiness of the accounting framework. But of course, the market is there, and this is what we do as financial accountants. Is we are providing information to the capital markets. So that is our primary task, and that is our product. So that is the goal. So last sentence maybe. What we really should have is more transparency between the standard setter, the user section, and the preparer section to really identify what is now material. And then I'll close.
Thank you. Anyone wants to add to this or disagree or?
I think I fully agree. I think what we need to see is a little bit more of probably the investors talking to the issuers. I realize, or at least I understand that there's a disconnect between the amount of time maybe that people have to engage, but I definitely think that needs to happen.
Yeah, I can also reflect on that. I love what you said about the mindset, because as a preparer, I always try to convince my teams indeed step into the shoes of the investor, of the recipient of your data, of your information. What is really the organizational narrative that you're trying to tell? And is it indeed understandable? Is it comparable? Does it make sense? I mean, we do have a tendency to use a lot of abbreviations, jargon, so really simplifying also your messages is a profession in itself, I think. And as an educator, IMA also educates management accountants. We really try to also help them with how can you bring your story to life, your organizational narratives, by using good visuals, summarizing, using really good examples that then also are really telling to investors, like what is it really that you're doing, what's your impact on society, your financial numbers, have comparable metrics. I think that's all really very critical. So yeah, stepping into the shoes of the recipients and zooming out. I mean, of course you need to have technical understanding about the requirements and the standards, but don't focus too much on the details alone, but indeed really zoom out.
Yeah, no, I would just say, I think it's obviously tough for companies, or there's a gauntlet being laid down for them. But a quick story about the Danish Financial Statements Act, which was introduced some years ago, which obviously increased the burden of reporting on companies. And after some years, the CEOs were asked, what do you like about this, or what don't you like? But what do you like about this piece of legislation? And 95% of CEOs said that it saved them money. So I think that obviously preparers or companies talk a lot about the extra burden that's going to be placed on them, but it is also an investment in their own systems, and they stand to gain a lot from that within their own companies. And I think, you know, consumers of the data expect that the quality is there, and it's not just investors or civil society organizations that will benefit, but also the companies themselves will ultimately benefit. And I think, you know, the previous presentation showed if you don't make the investment where you know the change is about to come, we all know how that story ends.
Thank you. Having heard Peter earlier, I think we have a duty to look left and right. So, can we talk about the form, perhaps a little bit? At the speed of things today, quality is also about information being timely and relevant. Do you have any comments to make on the fact that companies are producing information, many months after the end of a financial period, when perhaps stakeholders could do with more timely information? How can we deal with that big question? Anyone jump in?
If it's all right, then I'll go first. I think that problem is well understood. You're a bit in a struggle of timeliness and reliability, because you want, if you are the CFO of a large company and you go to the market and say, well, that's the earnings, that's the revenues, that's the cost of sales, that's the margin, then you want to be absolutely sure that that's correct. And of course, markets are demanding quick information. That's why companies tend to make earnings calls prior to the publication of their financial statements, which in my view doesn't deteriorate the necessity of financial statements. But I think technology can play a big role in getting faster if you can produce reliable information quicker, on the one hand. On the other hand, we have to acknowledge that we live in a complex world. Transactions are very complex. Accounting rules tend to make them even more complex. And to get that to a good, reliable, and digestible result, that is the target that we have, and that is not always the easiest one, and it takes a bit of time. But I can tell you, at least from what I observe among German companies, there's a bit of a challenge who's reporting first. So we're trying to get faster and beat our competition, the accountants' competition.
Can I reflect on it? I think it's also important to note that there's sometimes a bit of a misconception that real time is always better, which is not the case, I think, because there's a lot of information that is helpful to get that real time. But to have like a summary or an overlay or again content, it requires time. I think reporting is also a profession. It's actually really hard to make a good report that contains good conclusions, that is structured, that contains good visuals, that really also is about the impact, also is about the ambition. So also finding a balance there with timing, I think is going to be an interesting one also in the future for reporting preparers, for standard setters. I think also now with the standards, there is a lot of actually debate about certain timing of crucial information. So yeah, I already mentioned the carbon credit. So what is it? Is it a commodity with a limited lifespan? Or yeah, so there are a lot of these topics which are going to pop up now also with the sustainability movement. But yeah. But also there, we're going to find a way to see, what's most insightful. I think that in the end is important.
I think what's interesting currently is we're obviously looking at trying to provide a lot of data. So you could think that you can produce a lot of data points quite fast and reasonably reliably. But I think I said earlier, it's the story that you want to tell. So data's good, but what's the story you're telling with it? And that's exactly what you said, Gwen. It takes time to actually then, take a step back and say, what's interesting? What should I be saying? And the other dimension to the notion of time is really, am I providing the right information at the right time? So, Michael, to your example about climate risk and financial statements and there's no impact, it's not necessarily that you're not allowed to say that it's an immaterial. It's actually, if people could think that in your specific company it should play a role and there's a zero number and nobody's saying anything, there is something that needs to be said, and that's not a data point. That's a narrative.
Well, just to wrap up here, I must say I don't know much about the internal workings of a company, but from I understand that there's a lot of emphasis on speed, but I think we need to put as much emphasis on quality as well, especially from our user group. Quality is really important. Now, if you look across where quality actually exists today, it's in financial data, right? So financial data providers, if you go between their platforms, their data has a 99% agreement. Whereas for ESG, that agreement is only 40%. So that's really the gap that we're looking at in terms of the quality that needs to be done or improved. And I think obviously the new legislation, CSRD, is a big step forward to raising the quality with the help of accountants to get to where we need to be.
Thank you very much. I mean, my personal observation is that some CEOs have learned the hard way that quarterly earnings don't necessarily work well with long-term strategy, but that's another issue. So let's move to the second theme of, let's talk about auditors a little bit. And I'll be very blunt, ask the question very direct. Are auditors doing enough to hold preparers to account? So who thinks yes and who thinks no?
I'm in the middle.
Yeah.
Yeah, shall I start? Well, I'm really in the middle because I think no, sometimes when I read a conclusion from an auditor, like with a double negative, we did not find any evidence that there was any misreporting, right? I mean, we see this a lot. So, and there I feel like, yeah, that's probably not enough because I want to hear also from the auditor, actually with all the complexity, it's good to get that real opinion from that auditor, right? Not just a professional, yeah. So I think there is for sure a big challenge ahead of us. On the other hand, I do feel for auditors because, yeah, I mean, now we have to find people that can say something about the numbers, but also can say something about the climate aspects and can combine these different expertises. So that's a big challenge. You also see that the big four firms are really challenging now, are struggling with finding the right people, educating them. So yeah, I do feel also for auditors, and I fully realize, again, as a preparer, I'm already challenged myself. So for auditors also, we're all learning how to validate the information. Audit work is also changing, right? Because again, with the new standards and the comparability, we also know that there's a lot of greenwashing. There is a lot of greenwashing. So what's the role of auditors going to be there with giving that also independent view on actually the quality of the reports that we're looking at? That will help investors, right? Again, not everyone will have the time or the urge to read through all these reports, right? But you do want to have a bit more like an independent view and conclusion, I guess, on what organizations are doing. And that will be necessary even more in the future. So yes and no, in the middle.
Tom, you look like
Yeah.
keen to jump in.
And the role of auditors. I mean, I spent 6 years working in the European Parliament as a communications person, not getting terribly up close to legislation. And I got to say, you know, the CSRD in this area, it's really exciting because it's a big leap forward. And what's being proposed here is to put accountants at the heart of the process. And that's obviously something new. It's a bit scary. And we're empowering assurers and accountants to say to companies, have you robustly engaged with processes like the double materiality process? And, you know, have you gone out there and spoken to who you need to speak to? Now, again, I think there's always that question of burden, but accountants and insurers really have now been given or are being given a really important role. And yeah, I think we can always do better, you know, individually and collectively. So I can't say for or against, but I can definitely say we're going in the right direction and let's keep going there.
So I'm going to come back on a report that we publish every year that's triggered quite a lot of discussions. And also with Accountancy Europe, and actually those were very helpful, I think, discussions. And we're very glad that they occurred. It was interesting because we'd published it for 10 years, and then all of a sudden, the European Commission put it in under the spotlight, and it was wow. So basically, it's our annual activity report where we say basically what our supervisors do and what type of enforcement actions they take, and we have an action rate, which, as it is around the 38 to 40 some %, which you can think is extremely high. However, we, as auditors, we approach supervision on a risk basis. So you can already see that if we select the most riskiest issuers, we're probably also more likely to find things there. So we do not say at all, and we are very cautious, we do not want this number to be extrapolated. So as it is, I think, and I can agree with Michael, that overall corporate reporting is good. The quality is good. Can it improve? Of course it can. So what I'm going to say now is I remember as a junior auditor these extensive lists of tick the box for disclosures. I don't know how it's done now. I hope it's no longer done that way. I hope the juniors who check the disclosures in the notes, because the notes are really important, that they know what materiality means, that they know that they have to put themselves in the shoes of the users. Are they too junior? Do they have enough training for that? Question mark. I don't know, and I'm not, preconceiving anything. I'm not putting a judgment there, but is there anything that within your audit processes you could do to make them aware? We publish enforcement priorities. We try to think about what's really important at the moment. So when COVID hit, also that wasn't an enforcement priority, but we tried to provide guidance and to what trying to put ourselves in the user's shoes, and what would the user want to know? I mean, first of all, is the viability of the company at risk? Are we driving, or is the audit profession training even the younger people? Because I also remember that the younger people weren't privy to the same types of trainings as the audit partners. Should that be changed? I don't know. Is that happening? Again, I don't know. But that would be where I think maybe a little bit more focus should be brought, really, because ultimately the materiality that matters is the one that's for the users.
Okay,
Michael, do you feel challenged enough when you are preparer?
well, when I look at my notes to that question, it simply says yes, where auditors are doing enough to hold us accountable. I'm quite confident, actually. We're discussing a lot on a day-to-day basis with the audit teams, and I think that's the correct way. We're sometimes fighting and arguing over things. I think that's part of the game, especially when it comes to the economic substance of transactions. What is it? Where should it go in the balance sheet? Where should it go in the P&L statement? But after all, yes, we're being held accountable to a sufficient extent. Absolutely.
May I take also a small side step? I think also Peter was also stimulating us to sometimes go a bit left or right. I think if I think about auditing, I also think about validation again. It will become more and more prominent, more important to validate, is the quality of the data correct? If I now, for example, see what ESG rating agencies are doing, that's also for me very fascinating, because if you look at the financial rating agencies, actually the outcome of different parties is very comparable, which gives you, trusting feeling, I think, like, okay, this is indeed a good information. But if you look at the ESG rating agency, there's an enormous overlap. So the spreads that they give on the quality of actually the sustainability of the organizations is very different. And then that gives certain organizations really access to cheap money, cheap funding. But then you can, of course, think, is this really the right mechanism to do this? If the spread is so high, are we then really getting the good outcomes in the end? So also they're validating data, the role of auditors, the role of ESG rating firms. That's going to be a big one, big responsibility. And in that field, I don't think that we're doing enough yet. I think that is really also something that we have to learn how to do that better.
So balanced views, I would say. Let's move to the third theme, which is looking at supervisors. So we'll probably start with you, Isabelle. I think it would be interesting to explore how supervisors are defining quality and what mechanisms are in place to promote quality in the market. So if we maybe start with you, Isabelle, and then we'll go around.
Okay, so that is a constant question. We keep asking ourselves the question. We discuss a lot about it. So the first thing is, obviously the language that we're all trying to use. It has qualitative characteristics. It has relevance, has faithful representation. In relevance, there's materiality. We've talked about this. And then there's obviously timeliness and understandability, comparability, and I'm probably forgetting one. Let me see, reliability or verifiability, depending on how it's called. So that obviously is really at the heart of what we're looking at. The other one is specificity. I mean, if all the companies said, well, we got hit by COVID, we all went and locked down. Yeah, okay, everyone did. Tell me what's new. Tell me what's the impact on your company. That's what people want. That's what users want to know. What's the impact on the business? What are the numbers we're looking at? So specificity is something that we really combat all the time. And then it's, yes, is the information that's produced in compliance with the disclosure objective? So again, objective, not does it tick all the boxes of the long list of disclosures that you could be providing? Does it fulfill the objective? So how do we do this? So we so at ESMA at least we don't have any direct supervisory power on company information. So what we do is what we call supervisory convergence, and that means that we gather the 30 countries of the EEA and that we discuss cases. So obviously financial reporting is the most advanced stage, quite established. To give you an idea, we discuss approximately 90 to 100 cases a year. 30 people, 30 countries discussing 90 cases a year. We sometimes publish some extracts of these, and that is to help the market understand. And we don't always publish enforcement decisions where the enforcer disagreed with the issue. We also publish some where, yes, based on the argumentation and the back and forth, we agreed. I mentioned our report earlier. In the useful discussions we had with Accountancy Europe, it was pointed out to us that those extracts that we were publishing were focusing more on measurement and recognition, whereas a lot of the enforcement discussions that we're having or that we're taking relate to the information that's disclosed in the notes. And so we've been trying to include more of these types of decisions. And that's one of the ways that we try to contribute to improving the quality. I mentioned the enforcement priorities, the various statements that we produced, and I remember 2020 as an interesting year where I think we produced 4 or 5 statements within a couple of months, so addressing various topics in relation to COVID. All of this to support the market. But it's also in how, so the discussions are not only about, the accounting, it's also about how we go about enforcing. So it's on the processes, and for that we have our guidelines on enforcement of financial information, which basically provides some principles of how we want to go about things. So I mentioned, for instance, how do we select issuers? We need to have a combination of risk-based, random rotation. We need to ensure that over a given time span, All the issuers on the market are reviewed, but we also need to address the riskiest. We need to also make sure that an issuer can't really guess when it's going to be reviewed, because otherwise. So then, what are the types of procedures? And here we run into differences in powers that are still existing. So we have to find some common ground, or we have to set out objectives as to how we go about things, even if in a different, potentially different jurisdictional setup. And then we provide transparency. I don't think there's a lot of regulators that publish such an extensive report as we do in terms of enforcement actions. And yes, we get challenged on it, and that's great. We're ready for those discussions. I think that's what helps the world move. It supports the discussion, and it helps improving. So anytime, don't hesitate. Come talk to us.
Thank you, Isabelle. Michael or Gwen, any experience as preparers of being supervised?
I worked for a bank for 17 years, so yes, I think I've had that experience. Yeah, no, I built also a lot of databases like EMIR, and I've been involved in parallel legislation, so yes. And I think that's a good dialogue, right? I mean, again, these trajectories we're learning also. I think that's also been mentioned today. So I really think that good cooperation is helpful. Yeah.
Can I add one thing, maybe? Because sustainability reporting is coming, or maybe not, we'll see, depending on today. But let's say that it's coming, and it's coming soon. And obviously, as supervisors, what we want is the level of quality to reach, and relatively soon, the same level of quality of financial reporting. Now, we know that the starting point is different. The timeline is extremely short. And here I really do want to acknowledge that we are aware of the difficulties that companies and auditors are facing. And so whilst we are working on guidelines for enforcing sustainability information, which are basically a copy-paste of the previous guidelines I've been talking about on financial information, more or less tweaked for some specificities in terms of sustainability information, such as, well, the definition of materiality is not exactly the same. So what's the impact of that? But so you'll see these coming probably relatively soon up for consultation. And yes, the ambition is to be at the same level, but we do recognize that there is an ongoing dialogue that needs to happen in the first years, as it did, if I remember well, when IFRS started. So I don't want people to fear that the enforcer is going to come and with the whip and everything. I do want the dialogue to happen. We won't condone any attitude that is obviously wrong, but we will be supportive.
Not sure whether I can confirm that that feeling doesn't exist when you're a preparer, that you're not coming after us with a whip. I would say the role of the enforcer, of the national enforcers, and then of course of ESMA, is a very crucial one, because you can argue with the auditor, to a certain extent, and there's always a last line of defense. Would you be able to explain what you do, and would you be able to prove that it's correct towards a completely independent enforcer who doesn't have the common experience? And so that also is, I think, quite a good supporting factor of the independence of audit between preparer and auditor. So I think that's a very crucial, and it's a very good role. What happens sometimes in practice is, as you mentioned, you publish some enforcement decisions across the EEA, the ECS database, if that's correct, yeah. And that is sometimes looked at as guidance. So if you have something that is somewhat similar to the cases that are being reported there, then you better stick close to that guideline, because that's sometimes perceived as safe harboring. So then is a bit so. You're
It should be a trigger for discussion.
yeah. We had the discussion at Business Europe already that it may be something, but you educated us on that that it's not authoritative guidance. But it's a good way to look at things and to, well, it's a collection of practice examples. So it's a bit more than educating material, but a bit less than a standard.
Thank you.
A little bit on oversight, a little quick thing. Yeah, another quick story. You know, at WikiRate, I talked about modern slavery, we've got tens of thousands of modern slavery reports, which we simply can't assess because they're not in the correct format. They're not in a machine-readable format. They have to be done manually. So, you know, when we think about oversight, civil society is happy to be part and play that role. And I think the legislation like the CSRD is a big step forward because of the format it brings in. It makes it all, it will make everything more comparable. It's going to bring this kind of single currency to the data, hopefully. And that's going to be, I hope, easier for companies because it's going to be more expedient, more efficient to know what to report. Obviously, there's always debates around that, but essentially it's going to be better for organizations like WikiRate, but also for investors to be able to assess how companies are performing and to see if the legislation is working. Now, of course, civil society, and we would love to also be part of, we are part of the discussions. My boss, who couldn't be here today, was in part of the discussions with EFRAG, Lorraine van Brain, and you know, I think it's a real it's really essential to remember that zooming out a bit, the biggest oversight is the public, of course, because the next generation of investors, I read that Gen X, Gen Z, millennials, 70 to 80% of those investors believe that investing in a company should do social good. And whereas for baby boomers, that figure is only about 30%. So change is coming. And the biggest oversight of all, of course, is the public.
Can I make one addition? As you said, if it's machine readable, it's better because it's comparable. Well, that I'm a bit, maybe you may call it critic about this or cynical even, because what we've seen with ESEF, and there have been a lot of discussions, that just because you name something identical doesn't mean that the content is identical. So we're always having this fundamental competition between reliability or comparability and usefulness. And so just, and that's where we should be careful about. Just because we give it the same name tag doesn't mean it's the same content. And I think when it comes to sustainability reporting, there's a lot of discussion on what is meant by that, what do they actually want, what is that data point. It starts with the consolidation scope, it starts with the measurement scope, measurement practices, what is included, what is excluded. So that's would actually be a precondition. If you want that total comparability, they would need to be very detailed in those prescriptions. On the other hand, you're about to lose some of the relevance of the information, but because it may be out of context.
A very quick response, maybe.
I just want to say, you know, more. We'd love to continue having that conversation because obviously it's a really hard one to have. But yes, it's not easy. But these are the details I think we need to work out because at the moment you can't see the wood for the trees. And I get that it's difficult when we're in the early stages, but you know, the new formats with tagging and so on is the way I understand it is there to help. And we would love to see more of that and continue having more discussions like this. So let's go for it.
It's key.
I also wanted to indicate a slight shift in what we're doing, which will be coming as a support to the European Common Enforcement Priorities at the end of the month, which is that we're going to be publishing a study where we've looked at specifically how climate risks are disclosed currently in financial statements. And, usually our reports are, X% produced satisfactory information, X% it was insufficient or unclear, whatever. This is totally different. So this one is about, we will publish some disclosures which we think are good disclosures and explain why. And we hope that that will also support issuers for their financial statements.
Looking forward to reading that. So we're in the home straight, and I'll ask you one final question. If you could try and answer it briefly, just not because I want to shorten your speech, but just to capture the essence of this. And the question is, if we look at the ecosystem with all parties in it, what, in your view, is the one biggest thing that could be done to improve the quality of corporate reporting? Whoever.
I'll go first.
Yeah.
I'll say what I've said before. It's the mindset. It's the mindset to provide the best corporate reporting, to make sure that everybody involved in the process is aware what is the target, what is the product, and that is the preparer, that is the auditor, that is the standard setter, of course, and the enforcer. And we all have to somehow, and we will never make that perfect match, but we need to somehow align of what should be done, what is acceptable to be done, and then we should have the freedom to do that.
I'll add dialogue, and everybody has to play their own part in the system.
Good. Tom?
Well, include civil society. I'm going to trumpet that. No, I'd love to continue having these conversations, and I think they're super exciting. And aside from that, continue to develop and empower accountants, I would say. I think they've got a real essential role in this, and I think it's a great vision for the sustainability changes that we need for the planet.
Yeah, I would say do it together, do it with common sense, and do it with the end goal in mind, long-term value creation.
Really, the theme is make the ecosystem work as an ecosystem. Really good. Thank you very much for all of your views today. A big thank you to Isabelle, Gwen, Michael, and Tom for joining us on this panel. A few things I noted down during the discussion. But I think what I will take, and again trying to link that back to the presentation from Peter at the beginning, is the importance of technology in all of this as well. That's been mentioned a few times, but I think probably more to come on this. And I really loved your picture, Tom, of the Jedi. One of the big issues in the profession is at the moment is attractiveness of the profession. I think maybe if we equip all new auditors and accountants with a lightsaber and
Provided
Jedi,
it's green.
I think that could have a big impact on this. So thank you for the idea. It will remain with me. So thank you very much. I think we can thank the panel in the usual way. And hopefully it sets the tone for the rest of the day and the panels to come. So thank you.
So I thought you were going to talk in front of an empty room, so I went there and interrupted a few lunches and a few conversations. I'm really sorry about that. But don't worry, you will have the opportunity to continue your conversations. There is a cocktail after the event. But if you want to enjoy the cocktail, we need to finish the event first, okay? So my great pleasure, actually, to give the floor now to my good friend Jens Paul, who actually is our deputy president, so I'd better behave. Jens, I won't go into your CV because that would take the rest of the afternoon, I'm afraid. But I will let you introduce your panelists and go on with this discussion on a diverse and resilient audit market. Jens.
Thank you, Olivier. And I'm happy to introduce the panel here. I'm going here in the middle, and I hope everyone has a mic. Here one. Yes, please. So. Marcel over here. So. Yes, we talked about diversity, and we are very happy to have a very diverse panel here. And because we have different perspectives, different nationalities, and different backgrounds. And our theme is building trust by serving PI's needs through a diverse and resilient audit market. It's a long title, but it's a very important topic, we think. And before I'm introducing into the topic, perhaps I would like to very briefly introduce the panel. Dagmar Rehm, the background is being audit committee chair, so that's her perspective. We have Marcel Welsink. He has a perspective of an audit firm which decided to leave the PI audit market for several reasons, and we are very interested in listening and understanding. We have here Laura Warren from the FRC, a regulator's view. And last but not least, we have Josina Kammerling, the investor's view, CFA Institute. You see, we are trying to approach this item from that broader perspective. What is the item? It's about not a professional view, an internal view, a discussion, how is the market, how are the opportunities. That's not the topic. It's about the public interest and the role of audit in the PI audit market, because we are witnessing in the last few years situations where audit committee chairs and companies are confronted with tenders where there is a felt or perceived or real lack of choice. So we are listening, and we want to discuss whether that is an issue and how this issue can be solved. And that's very important, not only to see the professional perspective, but also the stakeholder perspective. And we have here backgrounds from jurisdictions where we had so-called audit orphans, which are called companies without auditors, and the reasons for that, and how we, and I'm not only talking about the profession, all the stakeholders can be part of a solution of that issue. And I want to refer to a nice document that I'm having here. It's a paper, a briefing paper, Accountancy Europe, published in March 2023. It's Dynamics Influencing Auditor Choice in the Public Interest Entity Market. That's a paper we tried to prepare as Accountancy Europe to set a little bit the scene for informed discussion, so to say. And now I want to be silent, and I want to give my distinguished panelists the possibility to give an opening statement, and then we are starting a discussion. And at the end, I hope we will have time for Q&A, and I hope that you are engaged and give input to our discussion. Thank you. And Dagmar, would you like to start?
Very briefly.
Yeah.
Does that work? Yeah, it works. Jens, thank you very much. Yeah. Out of my experience as being a chairwoman to an audit and risk committee 4 times, effectively, there are 2 PIs in Germany. There are multiple reasons why the choice in auditors is limited, and not all can be solved by regulation, that is for sure. Some are out of experience in the pure interest of the respective companies who are for whatever reason, on this occasion, simply not interested in being your auditor. They rather do something else for you, where they, for example, earn more money or they don't have the people. So I think it's worth looking at from very many different angles prior to coming with a solution in the sense of that needs to be solved as a BC. Be careful, I would say.
Thank you, Dagmar. Perhaps, Yasinia, you're coming in next. I think you can use it. Just
Is
try
it open? Yeah. Oh, great. Wow, automatic. That's wonderful. I would say there is one short phrase that to me would frame this debate. It's mind the gap. And why do I say this? Because we are all in silos. I am your investor. You know, we're all in silos here in this panel. You're all in silos. Do we manage to talk the same language? Do we look at the expectations we have of each other in the same way or in a different way? Do we need to look at it in the same way or in a different way? We have a very complicated climate in which we evolve, which is, you know, the challenges of new technology, the challenges of enormous amounts of data, the challenges of dare I say it, regulation or under-regulation. The challenges of public and private markets, which are behaving in different ways and in different areas. We know that in Europe, listing has been a problem. So when we look at pies, well, you know, the population of pies is decreasing. Do we want that? So I have plenty of things that I will talk about in the first round that mind the gap.
Thank you, Yasina. Marcel, your starting statement, please.
Yeah, I think I have a bit different perspective. In my opinion, there is no need for more competition because companies do the whole audit market is regulated by the Big Four. The companies are choosing for the Big Four. The whole audit reform of audit rotation, it turns out to be within the Big Four. So in fact, companies do not need another auditor.
Quite provocating. Thank you, but I think that's a discussion we have to have. And that's perfect for you, Laura, from the FRC, because they're thinking that there might be a problem. Am I right?
Well, I feel that means I don't need to do my job as Director of Competition Policy. So I think you've laid down the gauntlet there. So obviously I'm going to be on the offensive. I'm going to say that given audit is delivered through a market, we want the market to work effectively. And the market doesn't work effectively. That's pretty clear. And I'm going to obviously advocate for more choice on the basis that if we had more choice, more competition, the market would be, you know, driving up audit quality. We wouldn't just rely on regulation to be able to drive up quality. And clearly we'd also have a more resilient market, which is a significant concern given we have had audit firm collapses in the past. So thank you.
I think that's a perfect start. We have different views, we have different perceptions, and we have different experiences. And perhaps with the first round of questions, we would like to structure a little bit the item. And perhaps we're starting again with the preparers or those who are looking for an auditor in a tender process or in an open discussion. And Dagmar, how do you see the matter now in your experience in your country and in the pies where you are active? Which kind of discussions do you have? Which experience you have, and which criteria are for you relevant for making the proper choice or the proper decision? We heard about the Big Four market. We heard about the challenging firms. What is your perception? And making it even wider, we talked about sustainability this morning, sustainability reporting, and looking even at that perspective very closely in the future, what impact that might have. So a long question, but what is your experience in this field?
Yeah, I went through 2 tendering processes, and the process per se is very regulated and is very detailed in Germany, as it is in Europe in general, in order to make sure you meet the annual general meeting, and it's an undisputed outcome there. So in both cases, I must say, we did a very diligent and very long exercise, meaning you kind of start with a request for information round, saying publicly that you are out for a tender for a new audit company. And please, everybody who is interested or seems capable of delivering these services, please raise your hand and come back to us, and on a couple of very simple statements like, how international are you? How is your network internationally functioning? Some top-level experience there. And in both cases, we had feedback of around 15, I would say. Never all tier 1, always one dropping out. Lots of tier 2, lots of tier 3. And then in both cases, we had a very diligent selection scheme by saying, what is really relevant for this company? And there is one, for example, quite frankly, they are very much China-based. So a company, an audit company that does not have a presence in China is out of the question. It's very simple. So that leads to a kind of selection to some extent. We then ended up with something like 8 interested parties still. Sent out a request for proposal. Request for proposal came back. And then we intensely discussed what are our selection criteria. And they're very much about, of course, technical things. For example, how does it work from a technical perspective? How is the international network is another one. How is the approach to the audit? Some offer shadowing. Some say, well, I'm not kicking in between. I only join after the former audit company is gone. Lots of different details. And then in the end, it's roughly 6 details, criteria by which you select them. And then we ended up with inviting, in each case, 4 parties. 2 tier 1, 2 tier 2, or 2 tier 3. And fortunately, one of them, without jumping too far ahead, in one case we did not pick a tier 1, so one of the big 4s. And why didn't we do it? Because this company best fitted what we required. They had a super, in this case, for example, a super Chinese market desk. They had a super German market desk in China, a Chinese in Germany market desk. And there's something in addition one always needs to take into consideration, I think, is the people. The people that come along and say, I want to be your auditor. And that had a huge influence as well. We simply liked the guys best. They had the fastest approach, the smartest approach. They were really concentrated on what they wanted to present. They had the best IT solution. So it's a process that took us in each case about 6 months, 7 months, I must say, to really properly select it. And our intention was never just to be on the safe side. It needs to be tier 1, or one of the big 4s. It needs to be one that really fits. It's really fit for purpose. The sustainability aspects kick in, of course, because you want your auditor in the end to do everything. The limited assurance, eventually reasonable assurance, and all these CSRD reporting that needs to be delivered, because you want to get it out of one hand. But I did not see too much difference there, to be honest. It was more about people, general approach, international presence, full stop. And fee is not so relevant, just 10%, 50. You can always cook them down if you want to.
Yeah, it's in the end a factor, but it's not the starting point of the discussion, I think. Yeah.
Mm-hmm.
And one of my experiences as audit committee chair was that we made a tender and we get only 2 responses for PI client, because many of the possible interested parties said we would be interested, and in former times we would have done it, participate on that tender, but we are fully booked, so to say, and we have no capacity for taking that. Do you have made such kind of experiences yet?
Of course. The second tender was in 2022. The situation was already tense, but I assume not as tense as it is today. And of course, I asked some of them whom I would have expected to place an offer, why they did not go for the tender. And the majority said, look, yeah, it's a capacity issue, of course, and we are currently tendering for somebody who is, sorry, but far more interesting than you are, which means bigger fees. Okay, understood. Some said, look, we have very interesting contracts with you on the advisory side, which we, from a formal perspective, could continue, but we're not going to continue. Because there is the line is pretty close, and most of the audit companies are pretty clear on if they are the group auditor, they do audit, full stop, nothing else. So all these juicy services around them go somewhere else. And some of them want to have a different cocktail, quite frankly, and some of them won't simply tell you why they didn't bid for you.
I think that's interesting. That's a development of the last few years where this intensity of felt efficiency of the market are increasing. So Josina, from the investors' expectation of auditors, do you see that shareholders should play a bigger role in the auditor selection, or that there should be more interaction between shareholders, investors, and the audit committee, or even the auditor in the process? And what is your proposal or your input to the diversity of the PI audit market?
Thank you, Jens. It's a very open question, and you know, you could actually talk for hours on this, but Olivier will kill me if I do that. So I will definitely not do that. Let me give you a few brushstrokes of what, when we talk about engagement, investors, ever since the Shareholders' Rights Directive revision in 2016, have had a lot more responsibility placed on them. As of course we are awareness in terms of what is responsibility, what is the footprint of the company, but what is the responsibility of the investor. So I found it very interesting that in 2016, when we surveyed institutional investors within the CFA world, we worked together with the London Business School with David Pitt Watson, and very interestingly, there's some graphs, and I would point you to that study, because there's some graphs where we actually see, you know, that there is an awareness on the part of institutional investors that they need to act for others, but it's still very much a passive awareness. And I think, you know, that possibly with the whole move on the, I would say, the ESG tsunami that we've been witnessing might have bettered that, but actually we don't see it yet. Now, put into that the society context, the Edelman Trust Surveys, the Global Trust Service, which I'm sure all of you know, they really indicate that actually consumers and people working in companies, but any stakeholders, let's say, are expecting action on the part of companies. They're expecting on the company boards, on the CEOs, on the management, to be aware of what is happening, be aware of the imprint, and to communicate. Far less emphasis is placed in that survey on regulation and on governments. So this is an indication into where the action should perhaps start. I'm not saying it is a responsibility, but where it should start. And then you get to the point that what I said before is that we're all acting in silos, and that our languages are so different. So there's, on the part, the company suddenly finds itself thrust with not just making profits. Oh no, we're responsible for a whole host of things. Great, how do we do it? And then, you know, someone gets to audit all the stuff that the company is doing. Wow, do we have the knowledge? Do university students, graduates who start to work in the audit firms, do they have the knowledge to ask the right questions? Okay, I don't know. Do you? Again, then we get to the investors. We also see that the annual shareholders meeting has become a very sophisticated, very well-run package, but is there time for questions? Is there time for questions about audit, or is it very orchestrated? Throughout the COVID period, what was interesting, there was a whole debate about whether the annual meeting should be also led with several different other meetings, more technical, more specific, where the right questions could be asked. Is that a solution? Is that a way forward? Or are we fragmenting knowledge? The other thing you need to know is that analyst meetings have been dropping over the last 10 years. And actually, that is a big problem. So at CFA Institute, we're also doing research because there was a lot of talk about how MiFID had influenced negatively the coverage by analysts. But actually, we discovered it was pre-MiFID. It's a general tendency. It's not MiFID. So there are far fewer analyst meetings where these kind of more nitty-bitty questions about the auditor, how it could be addressed. So again, it's about that engagement. We also see that actually over the last couple of years, active investor engagement has been dropping. Well, okay, we have ESG, we have all this stuff. And then when I talk to my members across the globe, they say, yeah, but data, we don't really get the data through the financial statement. We don't really, we want other, a lot of information is still missing. So I think it was a green think tank in London, I can't remember their name, a couple of years ago, looked at the financial statements of the 50 biggest listed companies in London and actually found that ESG coverage in the financial statements was actually lacking for 75% of them. So the challenge is huge, and this is not a blame game. I don't sit here as an investor saying, companies, you're doing wrong, auditors, you're doing wrong, regulators, you're doing wrong. No, it's not a blame game, but what I say when I go back to that mind the gap is we need to bridge the gaps, and we need to have a chain of engagement and understanding, and only then can we really start to work correctly.
Thank you for this perspective from shareholders. I'm now coming back to you, Marcel, and I'm a little bit curious. What is your experience with the specific, perhaps, audit market in your country, and what did it take to enter the market, and how did the tendering and serving the pie audit market is going in the Netherlands? And then what was the background for the decision your firm has taken to leave that market? And perhaps what are your clients today, and with the retrospective, what you're thinking today of your previous decision?
Yeah. Thank you for that question. From origin, Grant Thornton in the Netherlands is a company for mid-tier firms. That is our background. At the time of the audit reform, I was very positive about the possibilities that could give us to enter into the pie market. So we were very optimistic about it. Due to the specific legislation in the Netherlands, for the pie market, you need to have a specific license. And that has a huge impact on the governance of your company. So, for example, we have to install a board of governors, a supervisory board with real power. And to do that in a partner organization is a challenge, especially when there are also tax people in that partnership, and they say, why would we do that? So it would have been much easier to say we are not entering into the market, but we did. And we tried, so we set up everything, we get a license, we went through all the partnerships and tried to enter into that market. We tried that for 10 years. So for 10 years, we really tried to get clients into that market. And quite often much smaller clients than our normal client base, because also in the mid-tier markets, there are huge clients. They are far bigger than pie clients sometimes. So also in the pie market, it's not only Shell and Unilever. There are also a lot of smaller entities. But at the end of the day, what turns out is to be honest, the perception in the market was difficult. So to overcome the perception, the perception was we can do it cheaper. So if we come to you, then it must be cheaper, because you are less experienced, etc., etc. That was quite often the experience. And what we found out, finally, only those companies come to you for which the tier one firms said, well, we are not interested because the risk is too high, or we had fee problems, or etc. So in the start, it were not always the best clients, also not from a risk perspective. And to be open about that, after 10 years, less than 2% of our turnover was in the pie market. So after 10 years. And we also found out that also our staff started to dislike it. They simply don't like it. Because it was too small, they were not specialists enough, the risk was too high, the fees were too low. So there was also in our decision an element of what do our people like, and that is the reason why we finally decide to say, well, let's focus again on what our core market should be. And therefore we decided to stop with the pie market. Although we left the whole governance. We left our supervisory board. Because at the end of the day, that was a good decision to have more and a better governance in your firm. So all the quality measures around the pie license we kept in place because we say, well, we are not changing the quality, because that is sometimes in our market the problem, that smaller companies think that an audit of a non-pie audit firm is easier or simpler or has another quality, but that of course is not the situation, and that is the reason why we finally said, and we were also discussing about ESG. For example, as a firm, we invest a lot of money in ESG. 10% of our staff is now ESG related. We did some takeovers, but for the mid-tier market. So we make our products and what we are doing specifically available for the mid-tier market. And till today, we think it was a good decision. We had some concerns that people might think, well, you are not a Champions League company anymore. Does it have impact on your staff, on your employees? But also employees finally said, well, it is good that it is clear if we come to work to your firm, yeah, in what market are we operating? So people, clients are basically very, very happy.
Thank you for this perspective. And the only question I would have, how your international network has reacted to that, because perhaps in other regions or countries, there's a need for having a high audit license.
Exactly, but we can still audit significant subsidiaries of foreign listed entities. We have our PCAOB registration in place. So we took care of that part of the business. So we are still operating in that area. So the decision was specifically for pies in the Netherlands.
I see.
And it doesn't have impact on the international network.
Very important clarification, I think.
Yeah.
Thank you. Yeah. So Laura, now to you. And I think the very interesting developments in the UK market and the initiatives FRC and others have taken. Perhaps you can bring us to the point about your recent initiatives aimed to increasing the pool of firms that audit pies, and which ideal situation you would like to see. So perhaps you can give us a little bit the background for your efforts.
Sure, yeah. So I think a key reason why we're in the space of trying to increase choice in the pie market is because as a regulator, we have a strategic objective to create a more resilient audit market through greater competition and choice. And so we've taken, over the last few years, various initiatives, and some of the more recent things we've been doing, introducing a standard for audit committees relating to their role on the external audit, which encourages them to think about diversity in the market, developing an audit firm scale box, commissioning various pieces of research and doing various bits of analysis to understand what is actually going on in the market, including understanding what some of the smaller firms who maybe audit just a few pies or don't audit in the pie market at all, what they think. So I think for some that might seem like it's not the usual business for a regulator who's in the business normally of setting standards and monitoring compliance and enforcing. But I think as part of the transformation of the FRC, and people in the room will be familiar with the fact that obviously there were lots of audit scandals, gave rise to lots of reviews in the UK, and the regulator is now subject to a transformation process. And so we are now very much seeing ourselves as an improvement regulator, as well as doing all the other things that we always did. And I think that's quite key in thinking about why we're in this space. So we have a 4 phases framework in how we approach our work. So not only are we a supervisor and an enforcer, but we're also a systems partner. So we're educating, we're collaborating, we're trying to support continuous improvement and be a facilitator, so encouraging good practice. So there's our objective as to why we want to be in this space. There's our approach, which is evolving to regulation. And then obviously, of course, as I mentioned, there's what the UK government's intentions are, and they've made it very clear that as part of the reforms to audit and corporate governance, they want us, when we become ARGA, to have a competition objective. They want us to have powers to introduce measures such as managed shared audit, which is deliberately designed to increase choice in the FTSE 350 part of the market. And they have made clear, the government, that ahead of the legislation, they expect us, working with them, to identify further non-legislative opportunities to increase choice and to stimulate a pipeline of market entrants for the FTSE 350 part of the market particularly. And so I guess that's all in the background for us. But then obviously underlying all of this, all of why we've got our objective, why we've got the approach we have, why the government in the UK is very bothered about this, is because what we know about the market. And as your publication has made very clear, this isn't new, the fact that there's a concentrated market and there's a limited choice. But, you know, that is a cause concern. It does give rise to the fact that the market isn't driving necessarily towards delivering high audit quality, and is certainly not resilient. And that was clear in the 2018-2019 Competition and Markets Authority audit market study. Very much set out why that was the case, very consistent with your publication and the factors that you highlighted. And that's not changed. So in 2021, the Big Four earned 92% of PI audit fees, 98% of FTSE 350 audit fees. So long-standing issue, one that's affected by many different factors, and one that, as you've identified, involves many different parties to kind of come to a resolution. But in terms of what we want to see in this space, in last year, in December 2022, we published our competition policy paper, setting out how we saw the audit market, what we thought about competition and our approach to competition in the market. And a well-functioning audit market isn't just about more choice. It has a number of elements. You'd want to see both sides of the market, the demand and the supply side, working effectively to drive up audit quality and to ensure there is resilience. So this is about getting the right incentives and behaviours in the market, and making sure that what we do as a regulator also helps to ensure that the market is working in the right direction, and that we're not creating adverse incentives or poor behaviours that is going to adversely affect that. So a good, well-functioning audit market, selection and oversight of auditors that's focused on quality. So we get competition based on quality. You're getting firms being selected because they're doing a good job, and firms not being selected when they're not doing a good job. You'd have opportunities to compete and sufficient choice of firms over the long time to ensure there is competition on quality. You'd have firms and individuals in the firms focused on quality, above all, audit quality, and not thinking about other things such as non-audit services. And you'd have regulation they're setting the right standards, monitoring, enforcing, but also providing lots of information to the market. So it's really clear for the audit committees, for the buyers of audit, what it is that they're getting, when they're going to be able to get a good auditor or not, based on the information that the regulator is putting out there to affect the market. So that's what we want, but not easy stuff, as as very clear.
Yeah, I think it's an evolving role and new role of regulators. You're describing it's not only the traditional position, but also feeling responsible for the consequences of regulation and, as you said, for the adverse effects of certain issues. Josina.
If I may, Jens, just to come in. Laura, I thought it really interesting what you said, and also, you know, the focus on quality, which I think is a really important issue. I want to bring to that, we did a COVID survey amongst our membership, and again, remember, these are buy-side professionals, lots of institutional investors, etc. And what had changed in their perspective was that they wanted to work together with regulators to change the market. Now, if you remember 2008, those of us who have gray hairs and remember the financial crisis, it was opposing sides. And I was working in the European Parliament, and I remember all the lobbies coming on to me and saying, "You're punishing us," and we thought we have to punish them. And this has changed, and that is to the good in terms of where we want to go. Sorry about that.
No, that's very interesting input. Dagmar, looking now to the scenery we have witnessed here, and you have made experiences with tenders, and you have also shared your experience, why certain firms have participated and what were the criteria. But you also said that there is now an increasing lack of choice, or a more intensive question whether we will find an appropriate auditor for a certain task. How do you think we could achieve more diversity from the perspective of audit committees? So which is the role of audit committees, audit committee chairs, supervisory board members, non-executives in different one-tier, two-tier models? What is the role to be, as the regulators are starting the process, what is your experience, or what is your recommendation?
That's a tough call.
Oh, yeah. I want to challenge you.
That is a tough call, because I, by nature, am not overly enthusiastic about solving really structural problems with regulation. Because, sorry for that, but when we look at the market, and I talked to quite a number of audit companies, they all come back with basically the same. We need many young people now to cover the ESG sphere. And all the young people say, "Oh, great stuff, super." It's far easy, because it's more fashionable. It's more about their basic concerns, what we can all see. It's less traveling, that's what they all come back with. It's far less risky than being an auditor. So, and it was only lately that PwC, sorry to raise them, one of the big four, but I tend to work with them on a couple of projects, said, look, we're looking for 40,000 people Europe-wide on ESG. In brackets, that's roughly the output of all German universities in a year of people who could do that, you know. So we are running out of stuff to some extent. This is something that cannot be regulated. It might be regulatable, but not in our sphere really. So this is a constraint we see, which will have a limiting impact on the capacities of existing companies, and especially on those ones that are trying to offer everything in order to be eligible for audit and other activities, and not concentrating on ESG or concentrating on advisory or splitting or some things. That's why I'm pretty critical about regulating. I think it's more about my experience. Just my experience is being a bit more brave, looking at what the company really needs, and I know that, for example, that's not an answer to your question on regulation. I know that, but and simply my experience is what happens if you have these audit tendering processes. The big four come in and say, well, we get a super IT tool. And that does just about everything. You don't have to do anything. It just screens everything and only sorts out things that look a bit critical. And then we talk about the few things that's easy audit. I've never seen it work. But the selling story is great. The investment story behind it is unquestionably pretty great as well for respective companies. And I know that a lot of the two-tier and third-tier companies simply cannot afford to put that much money into an assumed artificial intelligent learning whatever tool that does the audit by itself. So don't believe in these stories. Be realistic what can be done and what you need. And that opens for companies, for audit committees, opens the spectrum a bit more than just being on the safe side. Again, this is something you cannot regulate. That has to do with common sense. And yeah, no.
No, I like
you know what I mean?
Yeah, I like your comment, being brave and being open. I think that's a prerequisite.
Look what you
Yeah.
really need.
Yeah.
No, very often you don't need the big price tickets. And even I was, for example, quite happy when famous SAP in Germany did not go for one of the big four. I said, "Ha, see, they were brave. They looked at it. They looked at what they needed." And and this is something there. I think a chair to the Audit and Risk Committee comes in to some extent and says, no, taking a bit of an outsider view and simply saying, look, you don't need that. You don't need it. Taking PwC doesn't mean you're safe for the rest of your life. Forget it. No, find the right auditor for your purposes. So, but sorry,
no,
it can't be regulated.
No,
Common sense can't be regulated.
No.
I'm sorry for that.
But it's a question of behavior and attitude inside of the audit committee. So very interesting. Justina, if from the perspective of investors, I think sometimes there are also discussions of making a choice for a certain audit firm, tier 1, tier 2, tier 3. What is a perspective from investors? Is it the opening of the market an issue for the investors? And if yes, what is the contribution investors can give in this discussion? And because, as we heard from you, Dagmar, sometimes the safest choice, or the so-called safest choice, is a criteria. How do investors react to that?
So, Dagmar, thank you for those comments about that you don't always need the Rolls-Royce or the big, the big approach. Because I think that's one big issue. But that again goes back to that we have all put ourselves in a sausage mold. We want the same thing, because if firm X is taking one of the big four, I certainly need to do that because I need to look professional to my investors. And my investors may actually ask questions why I'm using a smaller audit firm. So, and you perpetuate the wrong in the market. And I like what Grant Thornton has done, is making a decision saying, this is where we see ourselves. And there is a need for that. And well, we do pie subsidiaries, but we don't need to do the whole pie, let's say. Good decision. Why not? That's where diversity comes in. And let me take you to some of the conclusions from our future of the investment industry, and then I'll go into the audit aspects. But what is really key, wherever you go, is that you build up diverse teams. And now I don't mean male, female, whatever. I mean diverse in terms of knowledge, in terms of checks and balances, in terms of asking questions. This is true for the companies. This is true for the investor. It's true for the regulator. And in my personal experience, so I've been in financial services for about 40 years. That says how old I am. But when I started off in the city, and I was in an investment bank, my team was composed of an archaeologist, a historian, a linguist, a lawyer, not an economist amongst them. And we were doing bond origination. Okay. So fast forward that 10 years down, and I found myself in a big banking group. I was asked when recruiting young people, they all need a Master of Finance or an economics degree. And everybody asks the same things, same questions. And so we find ourselves in this situation we are in because we thought that we were building better teams, more knowledge into a corner, and we all forgot. And by the way, this is not just about companies, and it's the same thing in banks with Basel II, for example. You know, it's exactly the same. We've gone into this mode that in order to have knowledge, you need to all look in the same direction. You need to build up, but we forget that we get blindsided completely. And so this is to that point of when you say, what do we need to increase the number of firms? No, I mean, there are enough firms, so just you need to diversify. And I think to the point of what Marcel has been saying, you know, saying this is where I see myself. And that means talking to the companies. The companies don't all need the same sausage either. Neither do the investors, but we need to establish that dialogue of asking the right questions. And in talking to some of my German, and later on, if you want, Jens, I can go a little bit into a survey our German society has done on audit quality, but maybe it comes in a later round. But I think it was, Dagmar, you were saying about, you know, people coming into the business. There's a need for 40,000, and it's the output of all the students in Germany. Well, you know, students are only now starting to learn about ESG. So you have this whole new population that is doing the audits, you know, they're 2-3 years into their thing, that actually don't know how to ask the right questions. So we need to build this process. You see comments coming from from the US that 40% of audit reports are flawed. Yeah, but I mean, this is normal. We're trying to grow something massive. And we don't give ourselves the time or taking that step back to make sure that the train we're on is actually the right one. And I think this is what we need to do. So, you know, most of the audit changes came 2014 and onwards. It's a very short time. It's a very, very short time to implement and to change the mindset. And I think this is really important. So I'll leave my comments about audit quality for later.
Okay, thank you. I think it's
Can
yeah.
I make an observation
Yeah,
on the staffing and ESG? We also see that problem. In the Netherlands, we are one of the few firms who said on the consultation that maybe it's better not only allow auditors to do that work, but also to choose other people in your audit firm. So because you need to have the quality. So that is very, very important. But we doubt whether you have the resources, and we doubt whether an auditor is always the most technical capable person to do it in all instances. But that is a very minor point of view, a minority point of view in the Netherlands. But we truly believe that well, taking these problems into consideration, and it is completely new. We are all swimming in the dark to a certain extent. Why should we keep it as auditors specifically for ourselves? Question.
I found it very interesting that you are combining diversity with the model of the firms, having different backgrounds, and you call it silos earlier, but they should interact. So I think another discussion we won't touch today intensively is a multidisciplinary firm approach, but I think that supports a bit that it's better to have diverse communities inside a firm. And the question is which talents and backgrounds we really need in a proper audit and accountancy firm. I think that is more strategic discussion, and that is, I didn't realize that we would, or I didn't expect it, that we would make the connectivity to the morning speech we have all witnessed.
You have an unexpected panel.
Yeah, that's great. That's great, spontaneous, and it's more authentic. No, thank you for that. But Marcel, I would like to challenge a bit the decision of your firm with a question: what would it need to reconsider? So, what would be the incentives to enter the market? What should be the environment, or which investments do you need? So which are the factors which would make you rethinking your previous decision?
Yeah, if we want to make it, because that's the basic question. But if we want to reconsider it, I think in essence we want to have a fair chance to get our pie of that market. And of course you can enter into tenders. I know from colleagues in abroad that tendering processes are very, very expensive for an audit firm. And if your success rate is less than 2%, then you simply stop with it, because that's how, at least in my view, economics works. And so it is not that we. So you need to have a fair chance. That is point one. And we believe at the time of the changes in the audit market, we proposed the concept of a consortium audit, which is more or less in line with your shared or managed shared audit. So give us the chance in big companies, in big firms, to show that we as capable as other firms. I think that is important, and it might also solve a bit the problem of companies who are too big to fail. Because if you have two auditors in one firm and one is failing for whatever reason, then at least you have another one. Although I'm not supporting the joint audit, because there you are both responsible and liable and that sort of things. But the concept of the shared audit, managed shared, I'm not exactly know what the difference is between managed shared and shared, but that concept I think is important. Third element is liability. And not only the liability in the amount of liability, but the impact of personal liability on auditors, on your private person is huge. And you cannot imagine how much impact that does have on individual persons. And that doesn't mean that we are not responsible for the quality we are delivering, because we have to deliver a quality. But that personal liability, especially for young people, they say, why should I do that? What is the reason? Why should I set my house at risk, and et cetera, et cetera. So that is how they are thinking. So also in our opinion, that is an area where you need to make improvements.
Thank you, Marcel, for this open sharing of your thoughts. But it's a perfect item for you, Laura. First, to describe what are the initiatives you are taking. And we heard the question from Marcel, the difference between shared, managed, shared audit. What does it mean? Perhaps a little bit about the thinking of the UK reforms you are in the middle of or starting to consider.
Yeah, thank you. So, okay, the difference between managed shared audit and shared audit is that managed is deliberately, obviously, as many in the room will know, there are already shared audits happening. The managed bit makes sure that the process does provide for the smaller firm to really get the things that you were describing, that get exposure to the audit committee, make sure that, you know, they get the opportunity to do good and meaningful work that grows their presence, grows their capacity, grows their capability, enables ultimately for them to be in a better position to bid for other audits as sole auditor, and they've got a real good opportunity. So it's a managed in the sense that the regulator would be really setting the rules, the framework for making sure it operated effectively in a way that would be different to the kind of current situation where you do obviously have shared audits. You said you didn't like joint audit, obviously many views on that, but clearly as part of the reforms, the Competition and Market Authority's market study in 2018-2019 recommended joint audit as a way forward to improve choice in the FTSE 350 audit market. And the UK government and the FRC, very clearly in response to that, felt that was a step too far in terms of the capacity and capability of the non-Big Four firms to sort of be able to do joint audits to sufficient quality may not be there at this stage, and also to the liability point about that might expose. So some concerns about that. So managed shared audit is born out of thinking about joint audit might be a step too far at this stage. It might be appropriate in some instances, but perhaps not across the market as a mandatory move. But managed shared audit should enable us to address all the different barriers, all the different issues why we have limited choice. So to the fact that, you know, at this stage, there may not be the capacity and capability amongst the smaller firms to be able to do certainly some of the bigger audits at the top of the FTSE 350. So they need the chance to grow their capacity and capability. Audit committees may still prefer to want to appoint a Big Four auditor, but we obviously want them in time to want to be able to feel that they could also appoint non-Big Four auditors. So it's a chance to address all the different things that are in the mix and kind of come up with a measure that would enable us to move towards improving choice in the market. So that's that. I mean, clearly, to be able to implement that, we need legislation. We continue to make the case that we would like legislation so we can become Argo and we can do all these things and we can improve diversity in the market. In the meantime, we've doing lots of other things to try and increase choice. So I mentioned earlier, we published an audit committee standard earlier this year, and that's in line with the government's plans for reform. So it has said that when we become Argo, we'll have the power to introduce a standard for audit committees, make that mandatory across the FTSE 350 and monitor it and ensure compliance. And part of that standard in setting out all the requirements that audit committees should be doing in respect to their role on the external audit, we have said they need to promote market diversity. They need to make sure their tendering processes don't preclude the participation of non-Big Four firms without good reason, and that they've got transparent and non-discriminatory selection criteria. And I should say, Dagmar, obviously, you know, it's not the case that all audit committees aren't already doing that. I just think this is in response to CMA finding that maybe not every audit committee in the FTSE 350 part of the market was doing that. So I think that's sort of part of trying to address that. We've also launched an initiative this year called the Audit Firm Scale Box. And that's designed to allow PI audit firms, our Tier 2 and Tier 3 firms, to obtain additional input from the regulator to support them to grow so that they're in a better place, ultimately, to bid for bigger, more complex audits. Also to enable firms that may come within the scope of the regulator, so what we're calling our new Tier 4 firms, to gain valuable insights in the event that they might think they'd like to become a PI auditor. It's very much a flexible mechanism, the Scale Box. It's early days for it, but we are engaging with all sorts of suitable firms about where they might need help, where we think there's areas of common findings in relation to those firms, where requirements might be changing, where those firms might individually need to focus as they grow. And then I should just say, to pick up some of the points that have been raised about capacity. So my team, Competition Policy, we're in the space of policy work, so it's lots of research and analysis and hearing about issues and initiatives from others, not necessarily delivering those initiatives ourselves. That might be others in the organisation. But we are commissioning and doing lots of bits of research. We have done some research with smaller PI auditors and non-audit firms to understand their views on entry, expansion and exit in the PI and non-PI audit markets. And we have also done some initial work this year and last few months trying to explore the UK market for sustainability assurance, with a lot of interest to understand what might happen in that market for us, and whether the developments since that bit of the market may have implications for the supply of statutory audit. So I think we're very mindful, as some of the discussions have alluded to, about what might be the sector saying about capacity constraints and limitations and sustainability assurance being yet more requirements, and the difficulty in recruiting sufficient auditors to meet all of these expectations. So I think we're very interested, certainly very interested in the discussion on that.
Thank you, Laura. And I think I would like to make a wrap up of that, but we have only 10 minutes, and I would like to have some interaction with you, with the audience. And do you have any questions to the panel? So please, Chris, perhaps someone will bring a mic. Thank you.
Thank you for the session. I was very interested, Laura, in what you were just saying about the measures being taken to reach out to potential smaller firms that could be PI auditors in future. Thinking about that in the context of what you were saying, Marcel, about what I understand to be quite a difficult set of hurdles if you want to enter the market in the Netherlands. My question really is this something across Europe which encourages these discussions to be taking place in every member state, so that you don't have a situation where maybe one or two countries never have very many smaller firms coming forward, and that can be traced back to some of the hurdles? Or is that something that's just left for each country, each audit profession in each country to sort of manage as best they can? Or is there a revisiting of what was done a few years ago, and now that we've seen not enough perhaps coming through, not enough choice, something being done about that?
I would say it is a discussion which is starting, and as we heard from you, Marcel and Dagmar, and you mentioned it too, Yasina, that it's not so long ago that we had an audit reform, but it's an issue which is on the agenda in the description of the whole ecosystem. We had this term this morning, and if you're looking at the consultation paper by the European Commission last year, I think it was one of the questions, the market. And we have the development in the Netherlands, especially, and in UK, where regulators were or are aware of a situation and trying to address it. So it is, you can say, the elephant in the room, or it is an issue which might occur. It's not yet really on the agenda, but there are significant indicators, I would say. And I would say it's my experience for the first time that clients, from the perspective of auditors, the clients addressing an issue, and not the profession because I'm going into the market or I'm not going into the market. Clients have an issue. So, but yeah.
Yeah, what I can add on that, what is specific in the Netherlands is the two different licenses, and that already in itself divided the market, and give a perception of a divided market. So you can argue and taking into account other new regulation in the Netherlands, where more audit firms needs to have a supervisory board, whether that is still necessary. But that is specific in the Netherlands. I think all the other elements I mentioned, if I speak to my colleagues in Europe, to me there seems more or less the same.
I think to some extent Germany is special as well, because we had the Wirecard case, and honestly we still haven't mentally recovered from that. That this could happen, and we try to more lines of defense, more regulation, more fisc, more whatever, which is not a European phenomenon, but a pure German one. It's really tight and drying everything out we can, to the extent that we can. But I think that's why we are still a bit more restrictive, more cautious than many others in the European community market, I would say. my impression.
Yeah, and perhaps that has led to a discussion of resilience of the market, which a term you mentioned too. So because what happened if, you mentioned it too in your description of a shared audit market. Other questions? No questions? Yeah, there's one question.
Thank you. Julia from Accountants Europe. I have a question from Laura. So in these attempts from the point of the regulator to increase diversity and resilience of the audit market, do you have any expectations for our profession?
So it's, I think, as your publication makes very clear, everybody in the sector needs to play a part. So I think they're not going to work unless everybody sort of wants to play a part. And partly, I think you hear, so for example, FTSE 350 audit committees will say, we don't have a choice. We don't have a choice. We're frustrated. We don't have a choice. But, you know, they have a role to play in that, in about making sure that they think about appointing a challenger firm, possibly, and not just a Big Four firm. And then, you know, the audit firms themselves, I think there's behaviours there that we know, you know, they need to grow their capacity and capability. They need to show that they're able to step up. They need to engage with us to improve their quality. We as a regulator have a role in this space. Investors have a role in this space. I mean, that's, I think, it's not anyone. So, you know, bridging the gap and all the other things. I mean, it's very much, it's got to be a collective effort. I think there is a recognition of the problems often, but as I think your publication said, there's no silver bullet, and there is a lot of angst and aggression and concern about any suggestion that then's made, like managed shared audit, as a proposal in response to the issues. But, you know, there is no easy answer in this space. And I think to make a significant change and to address it is going to take, you know, collective effort and a willingness to kind of, as a system, to come together and work effectively.
And if I can complement to that, I think it's not being afraid. And, you know, we have acted out of fear. And I think we have to put that aside. We have to look, you know, and something in CFA Institute, when we talk about ethics, for example, we go beyond having the ethics code to saying give voice to value. It applies to what we've been talking about as well. Looking to the value of what you're actually saying, what you're writing. And just two points from this survey that we did with our CFA Society Germany. 80% of those surveyed don't agree with the fact that there is sufficiently publicly available information to evaluate the quality of an audit. That's a big amount. And then less than 20% of the respondents used the information from transparency reports. And a majority say that transparency reports don't provide the relevant information. And put that into conjunction with that, you know, can investors ask the right questions at the annual shareholders meeting? Is there time for that? Put that to the fact that there are less analyst meetings, and you start already having, you know, we need to have the conversations.
And I think that's a very valid point, and we have not put it on the agenda to find the solution today, but to start a process of communication on that, because, as I mentioned, it's a little bit the elephant in the room, and it's becoming bigger and bigger, and I think it's the right audience here to start a discussion and to look at possibilities, solutions which are tried, research projects which are ongoing, and I think by that, sharing this information, this should be the platform where we discuss it, and not what was perhaps the perceived or real outcome of the last audit reform. Something was picked up, external rotation as an example, and my feel is that all the pro and cons and the unintended consequences were not fully disclosed, discussed in a proper manner, because it was a hectic solution finding, and we want to avoid this in this context. We want to start a discussion, and thank you very much to the panel, to Dagmar, Marcel, Christina and Laura for participating and for bringing this input. And I think it's a good starting for a very interesting journey. Thank you. It's break now. Thank you. 15 minutes break? Okay, thank you.
We've decided, my good friend Andrew and I, that we would have a very easy allocation of role. I'm doing the bad guy that is calling you back into your seat, and he's doing the good guy who's introducing the panel and getting the conversation going. So I think I've done what I could. There's still a couple of people actually talking over there, and I will chase them during your introduction of Michele. Is that okay?
That's very good. I have
Thank
to say,
you,
you're
Andrew.
doing a very good job at being a bad guy today.
Well, only today. That's good news. So, ladies and gentlemen, let me please introduce Andrew Hobbs, who is the vice chair of our corporate governance group. And I think he's got a day job with a firm called EY or something, no?
Something like that.
All right, okay. Good luck.
Thank you, OJ. Good afternoon, everyone. It's my job to kind of guide you through the final session. And we're going to try and expand your minds a bit. I thought Peter today was great. I don't know how everybody else thought, but one of the things that Peter was talking about was that the concept of the never normal and the pace of rapid change. And I was very struck by the quote that he made that he said, we can't keep operating with yesterday's logic. And we're here today to talk about a corporate resilience network. Now, yesterday's logic is what we do when there's corporate failure, which is, as I think it was Yosina used, this blame game goes on, people retrench into their own positions, siloed investigations happen. Are the learnings really shared, or do we just do stuff and then feel better that we've done something? And it was against that background that Accountancy Europe had the foresight to think, well, could we do it differently? Could we apply tomorrow's logic to this problem? And they've come up with the idea of a corporate resilience network. And what we're going to do is discuss this concept using a panel of experts, but we're going to try and change it up a little bit from the other panels. And we're going to have some conversation starters. So I'm going to ask Michele Casso to take the stage to tell you a bit about Accountancy Europe's work and the paper that they developed. And then I'm going to talk to Annika Bovens, who's I'm delighted to see is with me on the stage now. And Annika used to work for the Dutch Safety Board. And the Dutch Safety Board, as you'll hear, was a great inspiration for the corporate resilience network that Michele is about to talk about. And after that, we're going to be joined by Isabel. Again, you're very welcome, Isabel, and Dr. Rainer Lentz, who should be on the screen joining us, and I'll introduce them properly in a minute. So without further ado, Michele, why don't you tell us what the Corporate Resilience Network is?
Yes, thank you, Andrew, and good afternoon, everyone. Is it working? Yes. Well, we know that companies fail sometimes for natural causes. Competition, innovation, puts them out of the market. That's part of life, and that's, there's nothing we can do about it. We have to live with that. But sometimes companies fail because of incidents, because of corporate fraud, because of audit failure, because of a combination of factors. And those incidents probably most likely could have been avoided. This is also part of life, but we believe that we can do something about it. And that's actually the idea behind Accountancy Europe's discussion paper on the corporate resilience. The two questions that we have to ask ourselves vis-a-vis incidents are what we can do and how we can do it. And as to what the discussion paper believes, that we should bring up the process of collective learning. The collective learning worked really well in other industries like the aviation industry and healthcare sector. And so the discussion paper proposes that we bring collective learning into the corporate sector. And as to the how, the discussion paper believes that a holistic approach should be embraced. A holistic approach is one that involves companies' directors, auditors, both internal and external, supervisors, investors, regulators, law enforcement agency, and so on and so forth. A holistic approach is essential because corporate failures are complex and quite often as complex as their causes. And so we need to have a lot of people around that table if we want to understand actually what went wrong. And also we need a holistic approach because current learning, if it happens and when it happens in silos. Because as Andrew just mentioned, sometimes, there are separate analyses of a corporate failure. Now, to bring collective learning with a holistic approach into the corporate sector, the discussion paper, in order to do that, the discussion paper puts forward the idea of a corporate resilience network. The ultimate goal of the corporate resilience network would be to analyze corporate failures, draw lessons, and in order to promote collective learning from mistakes. What would the main features of the corporate resilience network be? I think we can at least point out at 5 main features. First, it would be an independent body. Second, it would bring together all the actors of the corporate ecosystem. I mentioned that before, to fully embrace a holistic approach to corporate failures analysis. And then it should conduct a rigorous root cause analysis of corporate failures to understand what happened, what went wrong. It should also, and I think this is a very important point that the paper makes, it should also provide a safe space where people will feel free to discuss, share information, and talk openly about their experience with corporate failures. Sometimes you have to admit your mistakes, or you didn't do something that could have helped to prevent that failure. And the possibility to talk openly about it is, I think, is going to be key, an essential point. And of course, then the network would, in the end, provide lessons, neutral recommendations for collective learning and systemic improvement. A bit of a challenge. I think it will be, if it happens, it would be quite difficult to implement this concept. But I also believe, and strongly believe, that it will be in the public interest. And if it is in the public interest, I think we all agree that it is absolutely worth debating about it. And so I very much welcome today's opportunity to discuss it. Thank you.
Thank you, Michele. Now, I hope that set up exactly what this concept is about. I thought you did a great job summarizing what is quite a complex concept.